So the next thing you need to know is that narrative and bias. Okay, narrative and bias, they kind of go hand in hand because if you either determine your bias, looking at the charts from experience, you'll right away know what the narrative is. Or you go in looking for the narrative and then you'll arrive at your bias. So I know that probably just confused you because a lot of you are struggling with bias. And what's the difference between narrative and bias? Well, let's go back to what I mentioned earlier about non-farm payroll. Let's assume that you watched my tweets, okay, and you're not a douchebag that's simply trying to take everything out of context. I said you're going to have non-farm payroll, and people are about to get wrecked. I said note the relative equal high. I'm sorry, note the relative equal lows on the 5-minute chart on ES. Okay, so where did I take your attention to first? Below the market. So right away, your mindset should be, and this is how you go into 2023 with me. When I'm talking to you live, okay, I'm not going to tell you this is where you buy, this is where you put your stop loss, this is where you put your target. I'm not going to do that. Okay. I'm going to show you how you can stop wrestling with knowing where the market's going to go because I've already taught you how to trade. I've already taught you what the patterns look like. You can get in there multiple times. It's easy to do that part once you know where it's likely to go. And you all know this. You know this. And many of you even say this all the time on Twitter, or you'll do it in your own video comments and videos. You'll say, I can see the entry pattern. And if I could just know beforehand, because the few times that you mentioned what you thought was going to happen, I got in there, I took the trade. It was easy to trust it because you said where you thought it was going to go. I'm going to condition all of you to not need me in 2023. Excuse me just for a second. My goal is for you to be independent in 2023. You will not need to watch ICT. You will not need to know what I think or my opinion. But narrative is understanding how they're going to deliver it. Who? The market maker. The algorithm, if they're going to be a manual intervention, which I believe non-farm payroll yesterday was. That was an absolute shit show. Like that was a beautiful run lower, but that's what you are trying to avoid. You don't want to be in that if you're trying to go long and you get caught in that in the wrong side. You try to do the bracket the market. Here's a buy stop, here's a sell stop, and then there it is. Sometimes you can get whipsawed and it'll tag you both directions. And that's the part about non-farm payroll that prevents me from wanting to trade it because I don't have anything in my repertoire to know when they will do that one-sidedness, like almost like a CPI. Like you watch me get wrecked with my opinion on CPI when I publicly thought this is what I would like to see happen, but I can't push a button. But this is what I'm subscribing to, and then just right on up, it just shot straight up. Well, yesterday I told you where I felt the market was going to go to. It was going to draw down first, and it's going to reach towards what direction? The sell side. Okay, so that's your bias. The bias is it's going to go down, but you can't take any entry yet because non-farm payroll is highly volatile. So you got to let that market hit, run, and then see what's left in its wake. Where did it leave opportunities to come back and either run for stops or go back and reprice to where there's an inefficiency? And I showed you that in the review yesterday. Okay. I sent a tweet out and said, what do you see on the hourly chart? Okay. I wanted you to take a look at your hourly chart and see what you saw. And obviously you can see the weekly opening, that gap, and also there was a volume imbalance from the daily chart, extend that through, and it went down to the buy side imbalance, sell side efficiency discount low. So all of that was mentioned in the little review that I did on Twitter. So go back and watch that. It's a real short little 2-minute video. But I mentioned that in a second tweet, I said, here's the buy side, and here's the sell side. Both are likely to be swept. Now, if I co-signed first that sell side's my interest, that's my bias. I'm looking for a move to go lower. And it's going to go, in my mind, the largest move is going to be where? Down. It's going to seek the sell side. Why? Look what it's done all week. It just kept pressing higher, 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 up into an imbalance on the daily chart. Once it's done that, then there was a shift in market structure. You saw me sell short in the middle of the week and get the biggest portion of the move there. with the $40,000 example from beginning to end. I didn't have some off-screen shit, okay, over leveraging without a stop loss as my example. I walked the whole fucking thing with no partial. So you saw the big move of the week. You saw me point where I thought that the non-farm payroll would aim for, but I also mentioned that both of those liquidity pools would be swept. So it created that sell-side imbalance, sell-side imbalance, buy-side inefficiency, or SIBI, big one-sidedness move lower. Okay. Then once the market had that report in its hands and it came down to a discount low relative to that imbalance I showed on the hourly chart, then you watch and see if there's a shift in market structure, as I outlined in that short little review on Twitter. Then that imbalance, I grade that. Okay, I get a full measurement of that, and I'm bracketing it off where 20 to 25%, 50%, 75 to 80%, and all the way up to a complete repricing of that full move down. That's grading a price swing. It's not used simply just in imbalances like that. I use it also when I'm doing price runs that are not really running back up into a SIBI or running down into a BISI, buy side imbalance, sell side inefficiency. And I know some of this is going to go right over your fucking head. And I know, but this is why you got to keep showing up every day. There's no ads here. I'm not getting paid to do this. I do this because I love it. I absolutely want to see you fucking crush it. And I know you can. You don't know you can yet, but I know if you keep showing up, you're going to learn how to do this shit and you're going to be a fucking menace. You're going to be making fucking money and you're going to know everything what you're supposed to be doing and what not to do. And these discussions is what gets you there, not the give me real quick, bullet point videos, learn ICT in 5 minutes. No. So once I grade those runs, either it's a price swing that I'm trading back up into, or it's just a trend, I'll grade those price swings where I think it's going to go. How do I do that? I have to know where it's likely to reach for. So it takes us back to the draw on liquidity. And that is where narrative comes in play. So if I told you early in the morning that both sides of that condition of sell side and buy side would be swept, okay, you're going to hear my stomach because I'm fasting. But the idea of that first run down, nobody would have expected to see it come all the way back up and take out those relative equal highs. But you got a tweet from me saying that they're going to take both sides of those. But I told you my opinion where it's going to go first, the sell side. So once it ran down to where a logical level of order flow should come in at a deep discount on that hourly buy side imbalance, sell side inefficiency being repriced to, and then returning to the weekly open gap where we take that and we extend that through the week. So we had that one-time pass through on the hourly chart where there's a green candle going up through that gap that opened up on the week. And then I said, okay, the way a market is balanced, okay, the way it becomes balanced is where if there's a gap, which is a real liquidity void, there's no trading at all, no printing by any candle, wick, or body. That is a liquidity void. There is no liquidity there. And folks, if you're doing videos and such and you're trying to teach my shit, I'm going to correct you here too. When there's an imbalance, okay, the market's not going back up there because there's liquidity. There is no liquidity there. There's none. So stop saying there's liquidity up here. There's no fucking liquidity. The algorithm is repricing up there to engineer and invite liquidity into the marketplace because buyers will chase that. So you're being schooled today. But I grade the price swing by knowing where it's likely to go. So the first premium array that I'm interested in was going right back up to the closure of that SIBI. If it goes beyond that, what will be the next thing? The relative equal highs I gave you in a tweet where buy side liquidity was residing. So I had to be at Bayview, John Hopkins, with my oldest son for a procedure, and I couldn't manage the trade or worry with it. So I just moved the stop loss up thinking, okay, it's either going to run or it's going to stop me out. Either one I'm fine with. And it just happened to come back and stop me out before I left the house to go meet him at Bayview. So when I know what I'm looking for and when you're going to know where the next draw on liquidity is. That's why you have to spend more time knowing that stuff, because entry patterns are easy. When every time I do a trade and I'm showing you examples of it, that's not cherry picked. That's me simply doing what I do. And you see that I know what I'm doing is right out of the notes and teachings I give you. Every single one of my pyramid entries are an individual entry opportunity that you could have taken too. You don't need the initial entries that I'm doing. I'm just showing you everything that I see, just to, by contrast, showing you that nobody else out there knows smart money concepts like I do. They can't do it. They cannot do it. And these are just low threshold shit. This is little stuff. 2023, I'm going to fucking blow your fucking socks off. But you start with this easy stuff, knowing where the market's likely to go, knowing that wherever the market is right now, or where it recently came from a low, if it's bullish and you think it's going to go up 100 handles on S&P, then you take a fib and you extend it from the low it just recently made that you don't have to necessarily be in along from. Or if you're lucky enough to know what you're looking for and you were in front of the charts as it happened and you bought that low, then you take your fib and you extend it up and you look for 25, 50, 75, and terminus. Terminus is the draw on liquidity, where it goes to. Inception of the move is the low in this case. So you're looking for these areas where what's going to form? Fair value gaps, order blocks, stop runs. They're going to occur at the 25, the 50, and 50 is going to consolidate because it's equilibrium. Look at what I showed you last night and think about what I taught in month 1 content of the core content, where I talk about the 4 stages of how markets deliver price. The algorithm does 4 major things. When does it consolidate, ICT? I just went through answering questions on my forum. I'm not going to give you those answers here, but I'm giving you clues in knowing how to know where consolidations occur. Consolidations in intraday price action will occur around equilibrium. What's equilibrium? The 50% of that SIBI. It doesn't have to go up there and completely close in that one big drop. It doesn't have to do that. That's where Chris Laurie's group and I differ. They like to see all that stuff. I know what I'm looking for. I know when it ain't going to fill. I know when it's only going to go in there in a little bit, and that's an institutional order flow entry drill. I prove it because that's what I do my pyramid entries in. You don't get that anywhere else. Okay. I'm not trying to kick sand in his face or anything, but I'm just reminding folks who's who and who you're listening to. It's just confidence and authorship. It's not arrogance. It sounds like it, but it's not. But having that graded price run, it allows you to plan. It allows you to expect and anticipate new entry patterns. And you may not have the equity or the experience to go in pyramid. Like if I go and I buy 6 contracts, the next wave of me entering is going to be 3. And the next one would be 1. Or if I go in with 8, I'll go in with 8 with the first entry. And when it moves in my favor a little bit, then I'll go in with 4 contracts, half of the initial one. And then the next wave will be 2. And then if I get another piece on, it'll be 1. So I'm building in those positions. I was doing that on Twitter years ago with a demo account, made it public, and I literally ran up every single trade I took on a 15-second, 1-minute chart, and a 5-minute chart. I was trading both sides of the directions, and I was trading 4.5%, sometimes 5% on the trades. Every single pyramid entry, I was using 5% max every single time I was doing it. And that's how I took the 5,000 and the 100,000 counts over to several $million. I did that very thing over and over and over and over again. And as the equity increases in the demo account, you get more equity used. And that's all that was. And I am absolutely fucking ready to do that same thing in Robbins if Vinny E. Mini proves he's in the fucking Robbins Cup and shows his account number, because I'm going to roast your fucking ass, bitch.